The red candle doesn't look dangerous at first. It's just one candle, a small flash of red on a screen filled with thousands of them. Yet somehow your heart begins to race. The profit that looked so real 30 seconds ago starts shrinking. The green number in the corner fades. Your fingers move toward the mouse. You tell yourself you're being responsible, protecting capital, managing risk. But deep down, something else is happening. Something older than trading, older than markets, older than money itself. And before you realize it, you've closed the position. Seconds later, the market reverses and explodes upward without you. You stare at the screen. Silence. A silence every trader knows. The silence after fear steals a winning trade. The strange thing is that this moment isn't rare. It's the beginning of a pattern. A pattern so powerful that it quietly destroys most traders long before they ever learn what trading is actually about. That's why so many disappear within their first 6 months. Not because they're unintelligent, not because they lack information, and surprisingly, not because they have bad strategies. The real reason is far more uncomfortable. The market discovers who they are before they discover who they are. And that's where our story begins. Every year, millions of people enter financial markets carrying the same dream: freedom. The charts look simple enough: buy low, sell high, follow a strategy, manage risk. The path seems straightforward until real money enters the equation. The moment money becomes involved, the market transforms from a game of charts into a mirror, a brutal mirror. One that reflects every insecurity, every impulse, every emotional weakness hiding beneath the surface. Most traders don't realize this at first. In the beginning, they're convinced the challenge is technical. Find the right indicator, find the perfect setup, find the secret strategy. But here's where it gets interesting. If strategy alone created success, the internet would have solved trading years ago. There are thousands of profitable strategies available for free. Thousands. Yet account after account continues to disappear. Why? Because knowing and doing are completely different worlds. The stop loss gets hit. Anger arrives. The chest tightens. The mind starts negotiating. One more trade, just one. Recover the loss. Get back to break even. Then walk away. Sounds logical. Feels reasonable. Yet somehow that one trade becomes 3, 3 becomes 6, 6 becomes disaster. And this reveals a powerful psychological principle. The brain experiences financial loss almost like physical pain. The same survival machinery that once protected humans from danger now reacts to a losing trade. The market isn't attacking you, but your nervous system doesn't know that. To the primitive brain, losing money feels like losing resources, and losing resources once meant survival was at risk. So the brain demands action, immediately. Anything feels better than uncertainty. Anything feels better than pain, even a terrible decision. This is exactly why experienced traders do the opposite. When emotions scream for action, professionals often become more still, because they've learned a secret most traders never discover. The quality of a decision is often highest before emotion enters the room. But that's not even the real trap. Something else is happening. Imagine standing in a crowded room where everyone suddenly runs toward a single door. You don't know why they're running, but your instincts tell you to follow. Financial markets work remarkably similarly. A chart begins accelerating upward. Green candles stack one after another. Social media explodes. Profits appear everywhere. People who never discuss markets suddenly become experts. And a strange emotional pressure begins building. What if I'm missing it? What if this keeps going? What if everyone else gets rich except me? FOMO arrives. Fear of missing out. One of the most expensive emotions ever created. History is filled with examples. The dot-com bubble, housing mania, crypto euphorias, meme stock frenzies. Different assets, different decades, same psychology. Crowds become convinced that this time is different. And that's when risk becomes invisible. Here's what most traders never realize. FOMO is not greed. It feels like greed, but underneath, it's fear. Fear of exclusion, fear of being left behind, fear of missing opportunity. And the solution begins with something surprisingly simple. Instead of asking, "How much can I make?" ask, "What happens if I'm wrong?" That single question has saved more accounts than any indicator ever invented. And this changes everything. Because surviving 6 months isn't about maximizing gains, it's about avoiding psychological landmines. The traders who survive aren't necessarily the smartest. They're often the most emotionally boring. That sounds disappointing until you understand what it means. While everyone else chases excitement, they protect consistency. While everyone else seeks certainty, they manage uncertainty. While everyone else reacts, they observe. The market eventually rewards observation far more than reaction. Yet another challenge appears, and this one is particularly dangerous because it often arrives disguised as success. A trader catches a huge winner. The account doubles. Confidence surges. Screenshots get shared. Friends become impressed. Everything feels different. But here's where things become dangerous. The brain starts creating a story. Maybe I'm naturally talented. Maybe I've figured it out. Maybe the rules don't apply anymore. This is where overconfidence quietly enters, and overconfidence has destroyed fortunes larger than most people can imagine. Throughout financial history, market legends, hedge funds, institutions, and billion-dollar firms have all fallen victim to the same illusion. The illusion that recent success guarantees future success. Markets have a strange sense of humor. The moment a trader becomes convinced they're in control, uncertainty usually introduces itself, aggressively. And the market was teaching a lesson hidden inside that success. Winning trades teach confidence. Losing trades teach awareness. Both are necessary, but only one usually gets attention. The strange part is that many traders survive losses. What destroys them is what happens after losses. Sleepless nights, constant chart checking, second guessing, self-criticism, the endless replaying of mistakes. The trade ends, but emotionally, the trade continues. Sometimes for days, sometimes for weeks. And here's the lesson most traders miss. Your biggest losses are rarely financial, they're cognitive. The inability to mentally reset creates more damage than the original trade ever could. This is why experienced traders develop rituals, simple ones, walking away, journaling, reviewing decisions instead of outcomes, separating process from results. Because one losing trade proves nothing, one winning trade proves nothing. The process is the signal. The outcome is often noise. And this reveals something fascinating about human nature. People naturally want certainty. Markets naturally produce uncertainty. The conflict between those two realities creates emotional friction. Every chart becomes a psychological battlefield, not between you and the market, between you and yourself, which explains a mystery that confuses many beginners. Why do intelligent people repeatedly make irrational trading decisions? Because intelligence and emotional regulation are different skills. A person can solve complex equations and still panic sell. A person can understand probability and still revenge trade. Knowledge doesn't automatically become behavior. Behavior emerges from identity, and that's where the real transformation begins. The moment you stop trying to predict every movement and start managing every reaction. The moment you stop asking how to win every trade and start asking how to survive every mistake. The moment you realize discipline isn't punishment, it's protection. The next time you watch a candle explode upward without you, something interesting may happen. You may feel the familiar urge, the pressure, the temptation, the voice insisting you must act immediately. But now you'll recognize it, not as market opportunity, as psychology. And once you recognize it, its power begins to weaken. Weeks from now, another losing streak may appear, the knot in the stomach may return, the frustration may revisit. The market will test you again. It always does. Not because it's targeting you, Because that's what markets do. They reveal. They reveal impatience, fear, greed, ego, discipline, character. The same way fire reveals the strength of steel. And one day you'll find yourself staring at another red candle, another position moving against you, another moment that once would have triggered panic. The heartbeat slows, the mouse remains still. No revenge trade, no emotional reaction, no desperate need to be right. Just observation. Because the trader who entered the market 6 months earlier is gone. Not because they failed, because they changed. And that's the irony hidden inside the statistic. The reason 90% don't survive their first 6 months isn't that markets are impossible. It's that markets demand a version of you most people have never met. The version capable of remaining calm while uncertainty screams. The version capable of accepting losses without seeking revenge. The version capable of waiting while everyone else rushes. And as that red candle continues flickering on the screen, you begin to understand something most traders spend years chasing. The market was never asking whether you could predict the future. It was asking whether you could master yourself. And for the first time, those are no longer the same questions.